Tom Piotrowski is live. How are we opening up today, Tom?
Pete, we're going to kick off in fairly flat terms today. A bit of a mixed experience as far as US and European markets were concerned. On the one hand, we saw the broader US market take a bit of a knock yesterday. The S&P 500, overnight rather, down by around 2/3%, and the Nasdaq was quite sizable in its decline. It was down by around 2%, although the Dow was quite conspicuous in terms of its improvement. It was up by about 0.5%. There's an important reason why the Nasdaq was down by 2%, and that was because we saw some rather high profile disappointments, I suppose, in terms of earnings numbers from Tesla and Netflix. So when I say disappointment, there were a few blemishes in the earnings numbers, and considering how far these stocks have run over the course of the year, we just saw a little bit of consolidation. But in terms of the moves, you had Tesla and Netflix shares down in the order of 8 to 9%. But if you put that in the context of where they've come over the course of the year so far, Netflix shares up by close to 50% in year-to-date terms, and you've got Tesla shares up by more than 140%. So that gives you a sense of why you saw that consolidation. Elsewhere, we had some quite solid news in relation to US employment. The number of people claiming unemployment benefits for the first time, that continued to fall, and that had the impact of pushing long and short-term interest rates a deal higher. So a two-year government bond in the US up by about 9 basis points to 4.84%. That's a pretty decent move in interest rate land, and that's part of the reason why you saw the technology stocks underperform in that context. European markets did well last night. You had the German DAX up 0.6%, the FTSE was up 0.8%, and the French market up by 0.75%. Mining, industrial and bank stocks did quite well in Europe, so we might get the benefit of that today. But everyone is focused on next week's inflation figures given the strength of yesterday's employment numbers.
Tom Piotrowski, thank you.